All right, good morning and welcome to another edition of the Main Management Weekly Market Note. This is the 250th anniversary of America, so happy 4th of July. Hope everybody stayed safe and came back to the office with all 10 fingers. Here's the offerings as usual on the performance side of things. More up than down. You know, year to date, clearly far more things in the black than in the red. On the bottom there, you can see the trailing week. Sectors 4 were lower, 7 were higher. S&P up 1.4 roughly on the week. Holiday shortened, and then on the left there you can see there's a little bit more dispersion in the broader indices. Euro stocks leading the way up 2, while emerging markets trailing down 3.3. So seeing a little bit of dispersion in there, but again, year to date, still everything's resoundingly positive. Recession dashboard, not a ton of changes here. The biggest news was non-farm payrolls last week that came in at 57,000 in June. Forecasts were like double that at 110, but a big reason for this is the very early Memorial Day pulled some hiring into May and thus out of June. So I think, we're not reading a whole lot into that headline figure. It's also still well above the break-even rate of, now we're thinking 25 to 30,000 on a monthly basis, which is far lower than it was a couple years ago. You're looking at immigration dynamics, baby boomer retirements, all that stuff kind of weighing on the changing, composition. You saw the U3 headline rate, unemployment rate down to 4.2. The participation rate, this is a little concerning, fell out of bed, dropping to 61.5 for the total participation rate, which is the lowest since March of 2021. As part of that's due to the labor force shrunk by 720,000. It's the smallest since December of 2024 at 169.4 million. The number of unemployed people also fell, so that helped bring that unemployment rate down to, they're at 7.1 mil. But again, the number of people not in the labor force jumped by almost 1 million people. That's up 2.5% year over year at 105.8 million. So you think on a base of 350 million Americans, a third of them who aren't in the labor force, which is not insignificant. But yeah, that's kind of the headline. On any thoughts on the underlying stuff?
Yeah, I mean, I was looking at the Fed funds rate kind of reaction to this. The takeaway that I saw was basically the Fed is not looking at the labor market right now. That's not really their concern. This report was weaker than maybe they would have hoped or the market hoped, but it was nothing that was too concerning, and their focus remains inflation. So maybe this kicks out a potential hike another month or so, but other than that, not really anything super impactful.
Yeah, I agree with that. I think we get the FOMC minutes this week too, so we'll see a little bit more insight into kind of the meeting where they kept, Morse's first meeting as chairman, where they kept rates unchanged, and we're actually a little bit more hawkish than people thought. Looking through a little bit under the covers on this non-farm payrolls on the left, wage growth has been a bit of a concern given the rise in inflation, but wages were up 35 bips month over month, slightly above forecast for 0.3% rise, and then now 3.52 year over year. Again, that's been that year over year figure, that blue line on the left, there's been very steadily moderating. And we're still, just now back in line with pre-pandemic levels. So it's important to remember that you really had some strong wage growth in there, and it's slowly just kind of normalizing as we've been seeing for the last 5 years here. And then on the right, you can see the participation rates. The 25 to 54-year-old cohort fell to 83.3. It's tied for the lowest since December of 2023. That's the green line. And then the overall rate's been more steadily declining, but it really kind of has dropped the last couple of months here, the lowest since March of 2021. So we're keeping an eye on these. Hopefully you'll get a rebound in that 25 to 50-year-old. So far, it kind of looks like it's, bumping against that lower resistance level of 83.2, 83.3. So we'll see about that next month. We did get the JOLTS report as well. This is a month late, as always, or a month delayed. But JOLTS were kind of little changed in May. Openings on the left, they're inched higher to 7.59, and the most since May of 2024. So good to see that kind of, hopefully put it at a bottom and working up. Openings as well, starting to maybe kind of trend back up. Those did move a little bit lower. Hires on the left on moving a little bit lower, and then quits and layoffs, increased a little bit, but not much of a change.
It is funny to me, looking at openings, you can see now I think you pointed out the most since May of 2024. And if you kind of thought about earlier this year, especially in the beginning of the year, the labor market was kind of forecast to be much, much weaker than it kind of turned out to be. You saw that in the non-farm payrolls as well. You had a weak month, but overall, the labor market's been fine. That's why the Fed is not cutting.
Worried about
they're not worried about it. So not a bad problem to have.
I think steady as she goes has kind of been nice. Better than feared has kind of been referenced a little bit. On the right there, we show the ratio of openings to unemployed persons back up to 1.04, openings per person. The highest is January of 2025. So that's because, number of unemployed people keeps creeping lower while openings have been moving back up. So that's a positive dynamic there. It is also worth noting, though, that we've had on net kind of, historically, we've generally had more unemployed persons than openings. So this ratio being above 1 is kind of abnormal as far as true history is concerned. But pre-pandemic, we were up at 1.3, 1.4, 1.2, 1.3 there. So, maybe normalizing again here as you kind of came off, you can see that spike really just distorted. We also got the ADP payrolls, which posted a solid plus 98K figure in June. Again, also, a little bit below forecast for 113K. But again, the positive takeaway here is this is driven primarily by small firms, which added 53,000 jobs. They account for like 45% of total employment. So to see the small firms continuing to hire, especially coming back over the last 5 months, that's a good development. We think that bodes well for kind of Main Street, so to speak. On the year-over-year basis on the right, large firms are still up the most at 155, but then small firms are now up second most, up 1.04% year-over-year, and that's the best since June of 2024. That total headline's up 61 bips, and the medium firms are kind of the only category in the red, but they're slowly chugging back up towards zero. Down 0.28% year over year. And then we got the job cut announcements. So we got on the other side of the, I guess you could call it the employment balance sheet, as you have, jobs created and then job cut announcements. But Challenger, Gray, and Christmas, the cuts retreated to 45,849. Continue to dwarf hires, which were up just 10,933. You can see the year-to-date figures on the left there in that blue circle. We have 443, almost 444,000 cuts versus 91,500 hires. So again, we're kind of on pace to continue that dynamic where in 2025, we saw the first time where cuts really outnumbered hires. We do go to seasonal burst in September, September, October, kind of seasonal hiring. We'll see if that can right the ship a little bit. But for now, hiring announcements at least are pretty anemic. As for why firms are cutting, AI is now at the top of the bucket. 101, almost 102,000 is the most cited reason. It's 23% of the cuts this year have been attributed to kind of AI, and that's already basically double all of 2025 for AI as a reason, which was 55,000. Market conditions are second, and then closing is third at 82,000 and 78,000. It's kind of funny. They cite market conditions and closing, and it's like, don't you generally close because of market conditions? But in any case, that's kind of semantics there. But AI definitely coming up more and more on the employment side of things.
I know I've mentioned this before, but the AI kind of citing that as a reason for job cuts is interesting because it's not a pure kind of a measure of reality, right? Like people are incentivized to say that they're cutting because of AI or that AI is, giving all these efficiencies, especially if they're like a publicly traded company. Like that's what's cool nowadays to say. And whether or not that's actually the case, I'm sure there's some amount of it that's true, but it's not like a true figure of saying 100,000 jobs have been taken by AI, I would say at least, because the incentives are there to kind of be not truthful.
And there's this is also, again, as we mentioned when we cover this report, but these are announcements. These aren't actual results. So these are plans that companies are announcing, and there's not kind of a follow-up that says, okay, you guys announced 50,000 cuts. Verizon comes out and announced 50,000 cuts. Like, did they follow through with that? Or did they end up cutting 5,000? Because that kind of, the reality is often not what is mentioned here. I would generally say it probably comes out better on the whole than announced.
It's also like they're not going to come out and say, we're cutting all these jobs because we want higher profits. Why would they wouldn't say that? Like, it's not a good.
No, I say AI is increasing efficiency and helping our margins, which is profits. On the industry basis, we're looking. On the left there, we show year-to-date net hires. So that's cuts netted against hires. There's only 5 industries that are positive. Entertainment and leisure is the most net positive at 2,500 more hires than aerospace and defense, and then tech on the other side. This makes sense. If you're going to cut AI is falls within the tech realm. That makes sense to me that that's kind of the most obvious show up, I guess, so far. But they're the most net negative by over 3x with 124,000 more cuts than hires, with 14,000 hires, 15,000 hires, and then 139,000 cuts year to date. And then on the middle and on the right there, you can see kind of the paths that we take. This is against historical averages going back to like 2012. But cuts are running largely in line so far. You know, there are only 30,000 more cuts year to date versus history, but then hires are where things are really lagging. You can see where it's 209,000 fewer hires relative to history. So that's kind of been the delta.
I would argue that, you know, we're talking about cuts, maybe not directly correlated to AI. I would argue that the lack of hires is probably more correlated to AI, where it's companies not wanting to go out and hire 100,000 people if they
can do 20 and then implement it.
Yeah, if they can wait a year and then the AI gets so good that they don't need as many people. Like that's probably where it's truly showing up. The cuts are probably
just absence of hires.
Right.
Yeah, exactly. Shifting gears a little bit, we got the FHFA home price index along with the Case-Shiller 20 City home price index. Both of those were down in May. FHFA down 10 bips while CS20 was down 4 bips. It's a third decline in a row. You can see those 6 months averages are rolling over. We did get kind of a little bit of a head fake, similar timing last year. So we'll see if that resumes as you get into September, October. But for the time being, those are starting to roll over a little bit. On the right there, you can see both the indices themselves basically sitting at all-time highs. So just, you know, still super elevated on the price side of things. And, you know, it's no surprise the market continues to be kind of stymied as, you know, buyers have to pay up in price and stomach 6.5% mortgages, which doesn't feel great. The year-over-year gains have moderated. The FHFA is up 2 and the CS20 is up about 1.1. So if you look at, you know, kind of the COVID distortions, those are near the lowest year-over-year increases since 2012. They're not negative. You know, prices are still going up. But again, you got to kind of start somewhere to turn over, I guess. But we get existing home sales this week. We'll see if that shows anything up. But kind of the reports I've been reading is the forecast is this going to be kind of stuck here while prices stay high until mortgage rates really come down. Then we also got construction and construction spending and factory orders. Basically, these were both, solid gains. Construction spending missed forecast a little bit, but it's now up 3 straight months, which is the longest streak since September of 2024. And then, you know, hopefully it's kind of coming back into positive territory there. You've seen a moderation and a dip, and we're going to start hopefully continuing back up. And then totally factory orders on the right dipped in May on transports, but X-Transports posted their 7th straight month-over-month increase to another all-time high, and they're up 9.5% year-over-year, which is the most since September of 2022. So indicative, you can see that arrow there just kind of chopping higher. In summary, you know, again, Nonfarm Payrolls in kind of half of what forecasted, but we're not too worried about it. May saw some, the Memorial Day timing in May saw a pull forward there. JOLTS continue to show things, you know, kind of steady as she goes. ADP similar. Good to see small firms leading the growth there. Job cut announcements outpacing hires continues to be, I think AI is showing up more in lack of hires than outright cuts, because cuts are pretty in line with history. Home prices remain high, and construction spending and factory orders, positive months here. So kind of, overall indicative of not a huge change in the broader economic picture over the last week or so. Not that the economy changed in a week, but kind of steady as she goes. This week we got service and composite PMIs. We get the trade balance. It'll be interesting to see if that's still affected off of the oil and tariff prices coming off from a year ago, more over a year ago still. We get used car prices, wholesale inventories, and then kind of the big pieces Thursday, existing home sales rounding out the week, and not a ton out on Friday. So again, as always, thank you for joining us and hope you have a great start to your week.
Thank you.
Thanks.